Understanding the mechanics of constructing the yield curve. The yield curve is a graphical representation of the yields, or interest rates of bonds of different maturities. It showcases the relationship between the short-term and long-term interest rates. Understanding the construction of the yield curve is essential for investors and economists alike. 1. Basic concepts. To construct the yield curve, we first need to grasp some basic concepts. Yield. The yield of a bond is the annualized return an investor receives, expressed as a percentage of the bond's current price. Maturity. Maturity refers to the time remaining until a bond's principal value is repaid. Bond types. Different types of bonds have different risk levels and maturities. For example, government bonds are considered safer than corporate bonds. Term structure of interest rates. This refers to the relationship between bond yields and their maturities. To begin constructing the yield curve, we gather data on bond prices and yields for bonds of various maturities. These data points are collected from the market and are used to form the yield curve. 3. Plotting the yield curve. Once we have the data, we can plot the yield curve. On the horizontal axis, we place the different bond maturities, ranging from short-term to long-term. On the vertical axis, we represent the corresponding yields, or interest rates. Connecting the data points forms the curve. 4. Interpreting the yield curve. The shape of the yield curve provides valuable insights into the market sentiment and economic outlook. 5. Factors influencing the yield curve. Normal curve. A normal yield curve slopes upward, indicating that long-term bonds have higher yields than short-term bonds. Inverted curve. An inverted yield curve slopes downward, indicating that short-term bonds have higher yields than long-term bonds. Flat curve. A flat yield curve indicates that short-term and long-term bonds have similar yields. This can suggest uncertainty or market neutrality regarding future economic conditions. Several factors impact the shape of the yield curve. Interest rate expectations. If investors expect interest rates to rise in the future, long-term bond yields may be higher, causing a steeper curve. Inflation expectations. If investors anticipate higher inflation, long-term bond yields may increase, leading to a steeper curve. Monetary policy. Actions by central banks, such as cutting or raising interest rates, can affect the yield curve. Supply and demand. Changes in bond supply and demand can impact specific points on the yield curve. Conclusively, understanding the mechanics of constructing the yield curve enables investors and economists to analyze market expectations, make informed investment decisions, and gauge the overall health of the economy. Want to learn more? Visit Claire Trifle on LinkedIn